We're joined by SkyBridge Co-CIO, Troy Gayeski. Troy, thank you so much for joining us.
Yeah, it's great to be here.
All right, Troy, we got to start with the markets.
Of course.
When you look at 2019, Jeffrey Gundlach put it this way to me: you could throw a dart and pretty much everything was up. So as we are now into 2020, what is your outlook for the markets?
Well, so if you think about, there's a disconnect between the real economy, corporate fundamentals, and markets, and the main explanatory variable for that is Fed policy. So when you think of what the Fed started to do in September, they started to expand their balance sheet by over $100 billion a month, which is on pace with what they did in QE3, and of course this came right after 3 cuts. So you have extremely accommodative monetary policy, which is driving risk premium lower and equity multiples higher. So if you look at the first 3 to 6 months of this year, it's more than likely that this trend of expanding multiples in the S&P continues, and we could see a scenario where equities are up 10% the first 6 months. Now after that, that's where it gets a bit dicier, because if the Fed does stop expanding their balance sheet, markets start to focus on the upcoming election, because at this point it's pretty much consensus that Trump will win re-election. Look, it's hard for a Republican to win Pennsylvania. So, you'll start seeing more volatility, we think, in Q3. But until then, enjoy the ride.
Yeah, Paul Tudor-Jones is out there with some comments at I believe yesterday morning at the World Economic Forum, comparing today's market to early 1999, I guess before the dot-com crash. Do you see it that way?
Yeah, so we've talked about this late last year. I mean, the question was 1999, or was 2019, 1998? And the similarities are pretty eerie in that, you think about 1998, the Fed cut rates 3 times, did temporarily expand their balance sheet because of long-term capital and the Russia default crisis. This time around, it was in order to stave off, some of the externalities or the negative consequences of the trade war. But then on top of that, out of the blue, they've massively expanded their balance sheet, and they've promised to do at least $60 billion a month in T-bills up until June. So if anything, this could be 99 on steroids. Now, we hope that we don't end up with bubbles, right? Obviously, that
sure sounds like one is forming right in front of our face.
100%. So what the Fed is doing now is they're running the medium-term risk of bubbles in equities, corporate credit, and commercial real estate in order to further reduce the near-term risk of recession. And we always remind our clients that the last 2 recessions were caused by collapsing asset bubbles, the first in equities, the second in housing. So, it's a dangerous game the Fed's playing. Ultimately, they wanted to decrease the risk of recession in 2020. We just hope that doesn't lead to a massive hangover in 2021.
Well, I want to get your reaction to President Trump's speech here at the World Economic Forum, really touting the strength of the U.S. economy, also the stock market, and then talking about the Phase 1 trade deal, and that he says that Phase 2 is coming quickly. From your vantage point, what do you make of his comments?
Well, look, I think what you make is that fortunately trade war escalation has ceased. I mean, when you looked at the path to recession at the end of 2020, it would have relied upon continued escalation in trade. We would have had CapEx continue to decline, business fixed investment continue to decline, and that eventually spread to the labor market. So now that situation has ceased to deteriorate, we're looking at somewhere between 2 and maybe 2.25, upside surprise at 2.5, with admittedly Boeing being a wild card. How much has that drag on manufacturing? So, on the one hand, resolution of trade conflict's been a good thing, but on the other hand, no one really expects this monumental Phase 2 deal that's going to lead to 3 or 4% growth. And by the way, the thing we always remind people of is the Fed actually did Trump a favor in 18, because if they hadn't tightened policy in 18, we would have had a bubble in 18, and it would now be collapsing in 2020, which would have meant he had very little chance of re-election. So, it's interesting. The president says a lot of different things. He's right that the U.S. economy is strong. He's right that we have had the successful completion of trade deals. But, we wouldn't have 4% GDP growth if the Fed cut rates by another 50 basis points.
I want to switch gears a little bit. This theme of the conference, among many, is climate change.
Yes.
And I hear a lot of people telling me they're really taking what Larry Fink at Blackrock said in his annual letter. As a person who runs money, are you willing to dump shares in good companies if they don't have those ESG or strong ESG goals?
No. I mean, look, fiduciary responsibility trumps all else. I think the point people like Larry and others have made is that we're finally reaching a point where you can actually have wealth creation tied to climate change agenda, particularly with the increased efficiency in photovoltaic cells. If you look at what Japan's doing with the hydrogen transition in their economy. So hopefully we're getting to a point where you're not forced to make that decision, either embrace ESG or stick to your fiduciary responsibility. Over the next 5 to 7 years, we think they'll be synonymous, and that you won't have to make those difficult calls.
Do you think BlackRock would cause turmoils in markets if they dump these positions? it could be pretty massive.
Yeah, look, I mean, they're obviously the largest owner of just about every stock on the planet, and as we move from a world of active investment to more passive, when they decide to shift policy, that can be very detrimental from a liquidity standpoint. And I think it's actually ironic right now that you see activist investors pushing back at passive investors who are theoretically overstepping their bounds in non-fiduciary areas. So it's fascinating to watch. Our main focus is clearly on the economy and markets, but that is a big part of the Davos conference, obviously.
And Troy, you've been coming here before, so I got to ask you, because we've been asking a lot of our guests this, what do you get out of coming to the World Economic Forum?
Well, for me personally and professionally, it's very similar to our SALT conferences, which we have in Vegas and we have one in Abu Dhabi. The difference is here they have current world leaders, current presidents. 2 years ago, I believe it was Xi. Trump couldn't make it last year, but he made it this year. Whereas at SALT, we tend to have ex-presidents and ex-members of the administration. So that's really cool, to see, 10, 15 feet away, listen to Angela Merkel explain, the transition from
Just fun to see her walking in the hall.
Yeah, it's very, very interesting. And then I think the dialogue you get with other business leaders on what their views are on the various policies coming out of the administration. Because remember, 2 years ago, most embraced deregulation and tax reform. I don't think there was a business leader in the world that didn't see there was merit to that. But the huge uncertainty was around trade. And how much would that hurt CapEx? How much would that slow growth? Would we be honest with the American people that there's a trade-off there? And so I think what's interesting is 2 years later, we have some degree of resolution. Obviously things are going to heat up with Europe, and maybe we'll get a phase 2. But so for us, it's being real-time exposure to other decision makers and understanding how the policies are going to affect markets going forward.
I wanted to get your quick thoughts on the trade deal. Secretary Mnuchin said today that there are no talks or really underway or no progress on a phase 2 trade deal. Is that a reason to sell stocks at these levels?
We don't think so in the short term because, again, the biggest issue with trade is a lack of escalation. I really don't think there are many macro participants or active equity investors that are hoping for a hug moment with China and everything's going to be great. So lack of escalation is one. I think what Mnuchin's basically saying is, look, we're going to keep using the carrot and stick approach. If the carrot doesn't work, we'll come with the stick, like they mentioned with Europe. And in the meanwhile, from an investment standpoint, focus on lower risk of recession and massive expansion of the Fed balance sheet. So don't use that as a reason to sell equities.
Troy Gayeski, Co-CIO of SkyBridge, thank you so much for joining us.
Great to be here.